So a call option. Really all a call option is that you're making a bet that a stock is going to go higher. Okay? Now, where it gets interesting is if, in its simplest form, if you think, say, Apple's going to go higher, you buy a call option. Apple goes higher, your call option appreciates. However, the other thing you can do with options is that if you don't think Apple's going to go higher, okay, if you think Apple's going to go lower, then guess what? Have you ever bought an option and it expired worthless? You know, say Apple's at $500 and you buy a $510 call and it expires worthless. You just lost all your money. Well, guess what? Somebody actually sold that option to you, and your money that you lost went into their account. So you can actually sell calls too. You can sell them to somebody else. That's called writing an option. Okay? And that's important to understand too. So call option is essentially you're making a bet that a stock's going to go higher if you buy it. Okay? But if you sell it, you're thinking that what your bet is that you're thinking, okay, somebody else thinks it's going to go higher, but you don't think it is. So you sell them the call option. And that's what's kind of nice about it. Okay? And you can't do that in futures. Okay? In futures, you're either long, either buying or selling. That's it. So with options, on a call, you can either buy a call, and that's a bullish strategy, or you can sell a call, and that is a bearish strategy. So if you do think a stock's going to go lower, you can sell call options to somebody else who thinks that it's going to go higher, okay? And that's called writing premium and collecting premium. And the most basic level of options is that if you want to buy options, you don't really need any approvals to do that, okay? So if you want to buy a call option, let's say it's $10. If you buy one call option, okay, and each call option represents 100 shares of stock, okay? So if one option is $10, you got to multiply that by 100. So $10 times 100 is 1,000. So to buy one call option, you're going to have to take, it's going to cost you $1,000 out of your account. Now, if it expires worthless, you just lost $1,000, okay? However, if you sold a call option for $10, all right, you just got income of $1,000 in your account, and if it expires worthless, you get to keep all $1,000. Okay, it's a very attractive strategy. It's actually a very high probability strategy. There's some inherent dangers about it. For example, okay, here's the worst call scenario I'd ever heard of. And it was a stock, it was like at $50, and they sold, or was it like $49 or something like that, but they sold hundreds of the $50 call options, like for $1. And they ended up, it ended up expiring worthless. They thought it was going to expire worthless. It only had one more day, okay, and they were going to make $25,000 on the trade. What happened is the next day they woke up, the stock was up $50 a share because it was getting bought out. And so instead of making $25,000, they got it hosed. They really lost a lot of money there. All right. So here's the deal with writing options. Writing call options is actually the riskiest trade you can do with options, okay? And that's why. So writing a naked call is the most risky option trade you can do, and that is why credit spreads come into play, because you can actually write an option and then buy a higher strike option as protection for that scenario. All right. So buying a call option, that is the least amount of risk that you could take. Selling a naked call option, that is the most amount of risk that you could take, because your downside is theoretically unlimited, okay? Your upside is limited, whereas your downside is almost unlimited, okay? Whereas if you buy a call, your downside is limited, but your upside is theoretically unlimited. So both strategies do have their place, and but I just want to make sure you kind of understand it, all right? So I'll read this real quick. When you buy a call option, it gives you the right to buy a given asset at a fixed price, which is known as the strike price, anytime before a specified expiration date. The option writer, the person who created the option which you purchased, has the legal obligation to sell the asset to you at the strike price if you exercise the option before the expiration date. Now, that's kind of a lot of mumbo jumbo. You don't need to worry about it too much. Just remember, if you buy a call option at $5 and the underlying stock goes up, then your call option is also going to go up, okay? I always think of a call option as a cheaper way to buy a stock, okay? It's almost, not quite, but it's almost like a futures contract on a stock, okay? It's not quite that simple, but again, instead of, say, putting up $500,000 to buy 1,000 shares of Apple, you could buy 10 calls at $10 a piece, and that would only cost you $10,000, okay? And you actually can control 1,000 shares of Apple. So that's why options are sexy. They do have leverage where people, so anyway, that's the call option, okay? And we'll kind of dive into the rest of this.